Hi everyone, it's Roy Güllüoğlu. Welcome back to the another episode of Market Update, where we talk about what's been going on the financial markets. If you like what you hear, remember to subscribe and give us a thumbs up. Today, I will briefly go over the economic calendar, like what has gone through last week and what to expect this week, because like it's again like a tight and busy schedule this week. Then I'll talk about the evolution of Japanese monetary experiment, which has recently made the financial markets really busy. So let's start with the economic calendar to evaluate the implication of the recent data flow last week and also upcoming data flow for this week. Yeah, first of all, with the PMI numbers. On Tuesday, 23rd of the April, we received PMI numbers across the world. So in the Eurozone side, the manufacturing sector, we received figures below expectation. As you can see here, from left to right, like these are actual figures, these are forecasts, and these are previous ones. So as you can see, we received like figures below expectations, especially for manufacturing, but the rest is the composite PMI and service PMI is higher than the expectation. The composite PMI data hits 51.4, marking like the best figure since May 2023. Actually, this data reflecting the divergence between service and the good inflation in Eurozone. It's the same story in US as well. Like still, the improvement in the service inflation couldn't catch the improvement in the good side. Same situation here. It's valid for Eurozone as well. And after the PMI that after the Eurozone PMI data, there hasn't been significant change in the rate expectation for the Euro case. Still, June rate cut is highly probable, and like it's around like 80 to 90%. When you check the US side, US PMI numbers, we received lower than expected numbers, which pushed S&P 500 futures approximately 1.5% higher as the lower than expected numbers implying rate cut, because like if the economy goes bad, that means okay, Fed needs to intervene, like they need to maybe cut the rates to like more than sooner than expected. With that mentality, the S&P futures approximately rose like 5.5%, 1.5%, sorry. And US side, like as I told you, still like growth related data is implying good pricing. However, in the Eurozone side, the mentality a bit different, I think, since the main concern had become the growth side lately, because compared to US still the inflation is the base focus. The Eurozone indices are looking for good economic growth related data to go higher. So that's what happened actually. When they see like a higher than expected PMI numbers for service and the composite side, that was a good sign for the Eurozone indices. So on Thursday, 25th of the April, we received preliminary GDP and core PC numbers for the first quarterly PC. Just as a reminder, this is different than the PC that we received last Friday. In the first quarter, real GDP increased by like only 5.6% quarter over quarter. This is a seasonally adjusted annual rate. And the majority of the weakness was due to slower inventory investment and increased imports. However, real final sales of domestic products rose by 2%, with real final sales to private domestic purchasers increasing by 3.1%. On a year-over-year basis, real GDP saw 3% increase. This doesn't align with the markets like stagflation. Stagflation sounds coming a lot lately, but when you see a 3% real GDP growth, like the portion of the stagflation is omitted. Actually, that narrative is kind of out of context currently. So also for the real GDP side, if you exclude net trade and inventory, the growth stands around 2.8%. Like 0.2% is omitted when you exclude net trade and inventory, and this value was 2.77 in the last quarter. So since both inventory and net exports average to zero over the long term, in the analysis it's like considered to be exclude, like they exclude them to find the underlying growth and focus on the other components. Like over the last 20 years, both net export and inventory have aggregated around minus 0.05%. So it's kind of like creating a crowd, kind of establishing a noise within the data. That's why omitting those might be a better evaluation. So in this GDP data also, government contribution has decreased, but residential investment is making up for it. So government spending was subdued for the first time in a while, and contributing only 0.21% compared to an average of 0.5% as a benchmark over the last 6 quarters. This average is 0.5 is over the last 6 quarters. So yeah, like in the real GDP side, that's the main. That's the summary. But when you check this core PC quarterly, this was from left to right again, like actual forecast. Like the forecast was 3.4%, but the actual number was 3.7%. But here the significant part is this number increased from 2%, which is huge. So like quarterly, when you exclude energy and good prices, 3.7% PCE inflation increase is too much. Like this development caused concern in the bond market and pushing the 10-year yield above the 4.7% last week. That was the main when we started to like last Thursday. This was the main reason of the volatility. There is only also a positive note about that. The core PCD inflation rate continued to show moderation and decreasing to 2.9 over like a year-over-year basis. So then on Friday, we received the actual PC numbers for March. Like that was the quarterly PC numbers, and this is the March PC number. Both on the headline and the core side, like month over month, when you check like this month over month data, both core PC and headline PC, you see that like sorry, my bad. Yeah, this core PC month over month and headline PC month over month. As you can see, it's like forecast was 0.3%. The previous number was 0.3%. And we received the same data, same for the headline. So this like both like a month over month data came parallel to the expectation, and the previous data also, like when you check the year over year data, you see according to forecasts for the core PC data, we see a slight increase from the expectation was 2.6%, but the actual number is 2.8%. And here also in the headline number, as I see, like there's a slight increase from 2.5 to 2.7%. It's slightly higher than the forecast. So the good news is about this March PCE is much more hopeful than the quarterly PC that we received on Thursday. That's why like that one like jumped from, as I mentioned earlier, like from 2.2% to 3.7%, which is really significant. But at least the March data do not suggest that significant change. Another like a good news is that Dallas Fed trimmed mean PC inflation came to 3.04% from 3.13%. Why this is important? This is highly like this chart, as you can see, downtrend is still intact. It is a really significant inflation indicator that Fed has been monitoring. That's why I put this here. So yeah, in general, in inflation side, that's the overall picture. However, like the pace of this inflation has apparently decreased since the beginning of 2024. Despite the data was not good enough, it provided some room, like this PC data, since it just came after the quarterly data. They perceive like positively compared to that one. That's why it provided some room to the indices, especially after the like considering the quarterly PC data, because like almost like from 2% to 3.7% quarterly increase is like almost 100% increase, and it was like the market was really cautious after that. It wasn't like a something slight change. Yeah. And here in this chart, you see the upcoming key events that have potential to impact the pricings in the market for this week. Overall, like last week ended positively for the US indices with the help of the positive monthly PC after the quarterly one. And we received like a positive earnings during the like still we're in the earnings season, and during the S&P 500 earnings season, according to FactSet data, 77% of the equities that release their earnings have exceeded the market expectations so far on the profitability front. Considering 74% average of past decades, 77% is a solid figure. However, the revenue surprise that we experienced for this earnings season falls below the 10-year average when compared to the expectation, according to FactSet. So this week's focal points include, as you can see, we have FOMC meeting this Wednesday, and there's going to be like employment data, non-farm payroll data we're going to receive on Friday. Additionally, the market will closely monitor earnings announcement from Apple and Amazon. So overall, for the Fed side, based on the recent data indicating strong, like robust labor markets and the slowing pace of disinflation, it is anticipated that the Fed will maintain interest rates stable in the range between 5.25 and 5.5%. But I think like we need to focus on more some hints about the details of tightening side, because they might decrease the pace of tightening, and we need to catch some hints about that during the meeting. And I will also personally be monitoring the mortgage applications, particularly in light of the last week's robust new home sales. It's worth to keep an eye on service side and the real estate sectors, since they're the problematic aspects of the inflation. That's why mortgage application is one of them. And the new home sales increased last week. I mean, still, it's really strong. We're still expecting to see some lagged impact of tightening on real estate market, but apparently data does not suggest such thing. And that's why any data hinting at developments in the areas becomes significant. Yeah, so the other topic that I want to talk about today is the monetary experiment in Japan. Everyone in the like a FinTwit world in X platform talks about Japanese yen, the decision of Bank of Japan. Like, what do all these stories imply? What does that mean? What is the story behind it? Yeah, let's try to find out. So after the World War II, the Japanese economic miracle happened actually. The main factors that allowed for this super rapid like growth in the Japanese economy were, first of all, like technological change, the increased capital, increased quality and quantity of labor, increased international trade. They received financial aid from USA. There was a political stability after the war. They planned really carefully and well learned, like well thought out, like economic policies. Those were the main factors that lying behind the this prosper times of Japanese economy. So all these factors lead to an expansion in the exports. As you can see in this slide, in the first post-war year, like 1946, Japan's export was around 100 million, and when we come to the 1956, that number increased to 2.5 billion. Like you can see, this is this this is a study research from that I received from Indiana University publishing, and in the like accordingly with the increasing salaries of like since the economy is doing good, with the increasing salaries of middle class households in Japan, the demand for goods exploded. uh, like thus the stock market and real estate market boomed until the 1989 sharp interest rate hikes by Bank of Japan to cool down the property sector. So the rising interest rates crashed the stock market and the real estate sector and pushed the Japanese economy into a deflationary period. So this hard deflation period forced Bank of Japan to lower the interest rates, but apparently it wasn't enough to create inflation. I mean, they were just jumping from one side of the page to the other side. Like the after the expansion, I think like there was a the intervention was too strict and too sharp, and that's why they see a hard deflation after that sharp interest rates hike. So as a result, like they started to try to create and create inflation. So this phenomenon of lowering interest rate in order to create some inflation, but like being unsuccessful on this mission, is called like famous liquidity trap. The central banks provides liquidity into the market to create inflation, to foster growth, but it fails to create a demand. This situation happened in Japan due to especially the habits of Japanese people also. Their eagerness to save more and spend less mentality um, was actually one of the main factors that created this situation. So in 2013, Bank of Japan did another quantitative easing and started to buy Japanese government bonds. It worked until 2014. The inflation rose to 3.7% from minus 0.7%, but the deflation came back afterwards. So this was actually the adoption of the negative rates in their lives, and the main goal was here to deter savings and also punish banks that hoarded cash. But it didn't work as well. So here you see in this chart the monetary base, as you can see, keep expanding. Like the trend is upward. Uh, but there is no impact on domestic bank lending. As you can see, it's coming down. So this is called this phenomenon is known as liquidity trap. That's why they were trying to create inflation, but it wasn't working, because why domestic bank lending tool is important. It should have been the tool to provide liquidity into market, because as it's happening as it happens in US case, quantitative easing was done through lending side. And the next step, after they failed to create inflation, the liquidity trap, the next step was the famous yield curve control. Maybe you heard a lot about that. The recent decision was about this in March 2024. So yield curve control means controlling not only the short term but also long term rates. This could by this way, they could keep rates low by threatening to buy bonds without always having to actually buy them. So the chart in this slide is pretty interesting. I think after the announcement of yield curve control, the Bank of Japan, Japan's necessity to buy government bonds decreased. It serves more as a guidance, this yield curve control. It serves more as a guidance, suggesting that the threat of potential purchases seem to be more impactful than actual buying. And after this, due to the low return environment, companies in Japan ended up looking abroad for better returns. Then Japan became the biggest foreign holder of US treasuries by surpassing China. Then in 2022, the inflation finally hit 2% target. But when the inflation came to 2%, the reason was not the consumer demand, unfortunately. The main drivers were the Russia-Ukraine war that brought energy costs up and weakened Japanese yen due to the policy divergence between Bank of Japan and the rest of the central banks. Because during all war periods, plus after the COVID phase, all central banks first they eased the monetary policy, then they started to tighten their policies. But since this special circumstance of Japan, there was a policy divergence, and USD Japanese yen exchange rate started to increase. So due to the weakening of Japanese yen, businesses companies like Toyota, Sony were doing great. Their profits were so high. So at the end, the leaders of these companies who were reluctant to raise the compensation in the fear of having a lot of fixed costs become kind of open to wage increases. And after the main labor unions secured the biggest wage increases in 30 years, Bank of Japan hiked rates first time in 17 years from minus 0.1% to 0 to 0.5, positive side, in March 19, 2024. And that's that. After that, naturally, when the rates are increased, it's expected to see maybe strengthening in the Japanese yen. But at the market opening this week, it rallied USD Japanese yen, as you can see in the screen right now. It rallied until 160 levels, and probably with the Bank of Japan intervene, and it got back to 156 levels. Just to try to evaluate the potential implications of this Bank of Japan transition of monetary policy, I would like to check the technical side first of all through this chart, and try to understand what this chart is telling us. Here you see the weekly chart of USD Japanese yen to examine the big picture. Regularly, we would expect to see, as I said, strengthening in Japanese yen. It's not the case for now. The market apparently is not convinced with the steps taken on policy transition. So technically, like there are two important long-term chart pattern in this chart. First one is, as you can see here, there is an head and shoulder bottom chart pattern after a downtrend with a price target of 200 approximately, and also after the breakout, the price formed here, as you can see, cup and handle, or we can call it ascending triangle chart pattern, as a bullish continuation after an uptrend. As you can see in the chart, price targets of these formations are approximately 200 and 180 respectively. Also, when you check the chart here, this is 40 week, which corresponds to, since this is a weekly chart, 20-day moving average. As you can see, like long-term moving averages are still carrying the trend higher. So, I mean, we saw here a threatening of long-term averages, but after that, price started to surge from there to make another higher highs. And yeah, technically, as you can see, chart patterns doesn't see any chart pattern, like, I mean, at least they don't suggest any turmoil right now. Here, like in this current here, it might work as a resistance, but we'll still. I mean, it will also, the US side will be so influential on this side as well. If we see rate cuts, this higher for longer narrative has also impacted a lot this trend, because it was also a transition, because at the beginning of this year, higher for longer was outdated. Like it wasn't expected, with the inflation coming high and hot, it came back, and also this affected the USD Japanese yen currency a lot in terms of policy divergence. And lastly, apart from the technical side, what might be the potential implication of this policy transition of Bank of Japan for especially Japanese people? First of all, we will start to see more expensive mortgages, and I mean, as I mentioned in the technical side, we would expect to see increase in Japanese yen. This is currently being postponed. A decline in Japanese exports. This is also related to currency. If we see an increase in the value of the Japanese yen, we might experience to see a decrease in Japanese exports. We might expect to see increase in investing in Japan with relatively attractive yields. That means maybe the domestic investment on UST might reverse back to the Japan, since they would have relatively high rates, and we might expect, with the increasing yen, cheap food and fuel, like fuel import, energy import for Japanese people. Yeah, we will see how much longer can Japanese yen can bear this level of rates, especially in terms of to compete, in terms of to import and stuff. But yeah, we'll see, and we need to monitor also, both, not on, because on the Japanese side we only keep some intervention when the rates come up, but apart from that, we need to monitor closely if the Bank of Japan will take any other additional steps on tightening path. Yeah, that's all I'm gonna tell you this week. I hope you found the information valuable. I really wanted to touch this the story of Japan, since it's been really it make really busy lately, the financial markets. If you enjoyed what you watched, please consider subscribing to our channel and for more content like this, and don't forget to hit the like button. And thank you for watching, and we will see you in the next one. Have a good one.